Welcome everyone to Group Term Life Insurance, getting your ducks in a row. Thank you all so much for joining us. The benefits compliance team will be answering the questions you send through the Q&A today. We will try our best to answer all of your questions, but if for whatever reason we are unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At this time, I'd like to introduce our speakers for today's call. Joining us today are Beth Allen, Vice President and Counsel of Benefits Compliance at NFP, and Sarah Burns, Vice President and Counsel of Benefits Compliance at NFP. Beth and Sarah, the floor is yours.
Thank you so much, Amber, and welcome everyone to Group Term Life Insurance, getting your ducks in a row. We always appreciate the opportunity to present to you all on our Get Wise Wednesdays monthly call. And so today we're going to be focusing on group term life insurance and the compliance implications of offering that benefit. As always, we have to tell you that the guidance that we provide is informational and educational in nature. It's not tax or legal advice because we are not your accountants or attorneys. And so any questions about how the law specifically applies to your plan should be addressed to legal or tax counsel, as well as the fact that the information is current as of today, I guess right now. So to give you just a brief view into our agenda today, we're going to talk first about kind of why we're discussing this topic now and why we think it is especially timely to do so. And then to level set us all on kind of what we mean when we're talking about group term life insurance and the requirements. Sarah's going to introduce some key terms and common design features. I'm going to come and talk about ERISA rules because when we think about the specific laws that group term life insurance needs to comply with, ERISA is up there, as well as the tax rules that Sarah will discuss that we get from Internal Revenue Code Section 79. And so we're going to talk about those two laws and their implications for group term life. And then we're going to just give you a conclusion with some takeaways on group term life coverage. As always, please enter your questions into the Q&A. And myself and Sarah, as well as the rest of the benefits compliance team, will answer those questions if we can, but we do our best to get you some answers on those questions. So I'm going to go ahead and kick off our discussion today with just an answer to the question of why we are talking about group term life insurance now. And as you all can imagine, we run across any numbers of compliance issues and failures and questions that make it clear that there are sometimes trends in non-compliance as it pertains to a specific benefit. And so I think the first reason that we're somewhat talking about this now is that we're really realizing that there are a lot of questions and really misunderstandings based on what the rules are surrounding group term life insurance. And because it's not necessarily, let's say, the medical plan or the major medical plan, or let's say dental or vision or some of those benefits that we think about more when we think about compliance, there's a lot of non-compliance going on as it pertains to the group term life insurance rules. Likewise, we've also noticed an uptick in the number of lawsuits that specifically deal with the group term life insurance benefit. As you can imagine, if someone thinks that they have life insurance on a particular individual or loved one and finds out that they do not, that is a really tough position to be in. And so we see lawsuits result as a part of that. And we've seen a number of those lawsuits go not just to, let's say, federal district courts, but even go up to circuits. And so that generally means that where that is happening, the potential employer liability for those mistakes now takes on kind of a bigger issue, right? And then because the DOL and the government generally are also going to pay attention to what comes out of the courts, when you see a lot of court cases that are indicating that there's potentially a problem in how a benefit is administered, you can expect that the DOL is also going to begin to enforce on that issue, right? And so we already know that that the DOL has started to engage in kind of dealing with plan service providers and employers on group term life administration issues or mistakes. And when the DOL kind of catches notice to something, takes note of something, then there's also the chance that the IRS would as well. And so there could be a potential for IRS enforcement as well. And so we think this is a good time to go ahead and just have employers or encourage our employers to review their group term life administration practices and policies, and make sure that they deal with any existing problems before the issue gets to be a lawsuit, or a DOL investigation. And so as part of kind of the fact that we are talking about this now, I also want to be clear about, what NFP can do to support our clients, and our members can do to support their clients as well, right? And so obviously part of what we're doing in today's presentation is just reviewing the rules on ERISA and Internal Revenue Code Section 79 and kind of making sure that you understand those rules and what they mean. Obviously, we know and have identified some of the administrative mistakes that employers have made that could lead them to be liable for issues. Even if the group term life is fully insured, these employers could be held to account for those mistakes. And so we want to point some of those out. Obviously, where there are issues with non-discrimination rules and imputing income under Section 79, we're going to want to make you aware of those, as well as kind of explaining a very hard concept, which is the straddle rule. And then finally, it might be a situation where NFP staff and employees can assist in communication between employers and the carriers that are carrying the group term life to make sure that everyone involved understands who has what responsibility. Okay. Now, what we cannot help you with potentially, as I mentioned on the front end of this call, is legal and tax advice, right? And so, we're going to give you a lot of information about what the rules are. And some of you on the call will come away and say, oh, I know we are not doing that right, or I do not know if we are doing that right. And in the event that you do have a failure already, we cannot necessarily help you fix that because that would be a legal fix. Okay, and so then we would recommend that you consult with legal counsel about your best path forward. So Sarah, do you want to come on and talk about just the key terms of group term life insurance and what we're talking about today?
Yeah, thanks, Beth. Thanks for setting the stage. So we're obviously talking about a very popular benefit. I think all of you on the call know that very well. Why is it popular? Well, there's typically a rate advantage, especially if you have an employee with a health history or a dependent with a certain health history that would impact underwriting if they were to go out and get an individual policy. There's also this potential for $50,000 in tax-free coverage under the code. And so can be really significant for older employees, say in the 65 to 69 age bracket. And we'll get into this, but that works out to about $190 or more saved in taxes per year. But in order to take advantage of that $50,000 exclusion, the plan has to satisfy certain non-discrimination tax rules, which we'll get into, but just to highlight why we think it's a very popular benefit. And then we want to define a few terms at the outset here that we'll talk about. Term life insurance, that's distinct from permanent benefits. So term life insurance is coverage for a fixed period of time, for a term with no cash value. It's not for the duration of the employee's life. It ends at some point. And then basic versus supplemental. This is a really key distinction. When we're talking about basic, we mean employer paid. And when we're talking about supplemental, we mean fully employee paid, EE, available on a voluntary basis. So you might hear that referred to as voluntary insurance. We're going to refer to it as supplemental. Evidence of insurability, or EOI, this is required proof of good health based on medical history that would be submitted to the carrier for approval before certain coverage becomes effective. And we're going to talk about a case where that was an issue and how to prevent a mistake with EOI. Guaranteed issue, that's kind of the flip side of EOI. That's coverage that wouldn't be subject to EOI. So we can move on to some design features. Great. So these design features are all going to vary by plan, and it's really critical for you all, for employers, to know the elements of your plan design and then be able to answer employee questions on these features. So here's a list of particular terms you're going to want to pay attention to. Eligibility, right? That's a big one. Is there an hour requirement? If so, do you have a way to track those hours? Is there a waiting period? When does coverage terminate? Guaranteed issue, or EOI, we talked about that, but that is likely going to be different for basic and supplemental and different for late entrants. Dependent coverage, are dependents eligible? And then how are dependents actually defined? Are domestic partners eligible? Are there age restrictions on child dependents? There likely are, right? But it could be maybe not what you think it is. It could be 18. It could be, we've seen 26. It could be beyond 18 or 26 if the child dependent is dependent on the employee for support or disabled. It could include stepchildren. That all should be laid out in the terms of the plan. And then age reduction formulas, that's when coverage reduces by a certain percentage when an employee reaches a certain age. And now conversion, portability, life waiver premium, sickness or injury provision. These next four terms are all ways that coverage could continue beyond when it would otherwise terminate. So what I mean by that is, say for conversion, that's an option to convert the group coverage to an individual policy without that EOI, without that evidence of insurability, when coverage would otherwise terminate. Think like when employment ends, right? So these are typically high rates, but it's a really good option for an otherwise uninsurable employee. Like think about an employee leaving work due to a terminal illness. The conversion option is going to be very, very important to them. Portability, that's another option to continue the same group coverage when employment ends without EOI. It may not be available. It may not be available to all employees. Like there could be a years of service requirement, but again, this should be addressed in the plan terms. Life waiver premium, or LWAP, that's an option to continue coverage if an employee satisfies a disability definition in the plan. So it's sort of like an LTD claim, but it's a disability claim under the life plan. Sickness or injury provision, that's similar. It's an option to continue after active work ends if there's a sickness or injury and the plan terms are met and the premiums are paid. And then also life coverage can be paired with AD&D, right? Where benefits would be paid for certain significant injuries or accidental death. So this is all going to vary. It's all going to depend on your particular plan terms, but our point here at the bottom is just it's crucial to know these unique aspects of plan design.
Thank you, Sarah. Okay, so now that you know what we're talking about, which is group term life insurance, we're going to go into the rules that apply to that coverage that you need to consider as you're offering the benefit. Okay, so I'm going to kick us off talking about ERISA's rules, and you're all familiar with ERISA and the fact that the vast majority of your employee benefits are going to be subject to that if you are an employer who is subject to ERISA, right? And so when it comes to whether or not ERISA applies to the group term life insurance plan, then the general rule is that life insurance is basically included in ERISA's definition of employee welfare benefit plan. It's actually one of the enumerated or listed benefits. And so that means it's subject to ERISA. Okay. Now, some of you may be on the call and say, well, wait a minute, Beth, I thought that ERISA, doesn't apply to voluntary plans, right? And we have our group term life insurance may have a voluntary design. Okay. And to that, what I would say is remind you that we're using the term supplemental to mean coverage that is paid for by, let's say, the participant for themselves or their spouse or dependent. And the reason we're choosing to say supplemental is because when you say the term voluntary, when it comes to whether or not ERISA applies, voluntary means something very specific. And the idea is that it meets the voluntary plan safe harbor under ERISA, which, to be honest, most group term life insurance does not actually meet. Okay. And that's because kind of the test there is a very facts and circumstances based test that basically requires certain things of employers that they don't generally necessarily do with group term life. Okay. And so again, it's a facts and circumstances based analysis. And essentially, in order for, let's say, a life insurance product to actually be considered voluntary, the employee would have to obviously have the choice or decision of whether or not they participate, right? So it would have to be voluntary from that standpoint. There can be no employer contributions. So the employer cannot pay for any of it, right? It would be 100% employee paid. And then also the employer must maintain minimal involvement. That basically means that the insurer or whoever offers the life insurance product would have to be able to publicize the program through, let's say, the employer's means. The employer would also potentially collect that premium, obviously, to pay that through post-tax deductions. And then the employer would send premiums to the insurer. If the employer does anything else, then there's an argument that the employer is endorsing the program, in which case it takes it out of the voluntary safe harbor. Okay. And so when we talk about, again, when we're talking about fully employee paid coverage, if we call it, just because we call it voluntary, does not mean that it actually meets ERISA's voluntary safe harbor. And so we don't want to get this confused. Okay. What I will also say is that, this conversation is about group term life, but some of you may offer life insurance benefits that might be universal, or whole life, right? And those, it is more possible maybe that those would actually potentially fit the voluntary safe harbor exception. But keep in mind that the determination of whether or not a life insurance product is a voluntary plan or offering is one that you probably want to work with your legal counsel on, because again, the vast majority of life insurance that's offered by employers is likely going to be subject to ERISA and not fit the safe harbor. Okay. Now, if the program doesn't meet the safe harbor, then the idea is that ERISA applies. And so that means that all of ERISA's requirements that would generally apply are going to apply to the group term life benefit, right? And so that means that the group term life is going to be included in the wrap document or the SPD, right? It means that the Form 5500 would include the group term life policy. So there would be a Schedule A if that policy is insured, and it would be listed as a benefit that is available to participants on that Form 5500. Now, when we talk about ERISA applying, obviously that comes with the reporting and disclosure obligations that I just mentioned. But I think what's germane to the offering as far as group term life plans is the fact that it also comes with ERISA fiduciary decisions, right? And I think that on the retirement side, the industry has kind of gotten this right. They understand that basically every employer is a fiduciary, right? And even though the money is held by someone else and they might have a record keeper that's doing all the job, employers understand that for their retirement plan, they are a fiduciary. And I think that on the health and welfare side, we have not done as great of a job, right? And so a lot of employers are like, well, hey, yes, I offer this health and welfare benefit, but the insurer pays it all. The insurer administers the plan. And so I'm not a fiduciary, right? And the answer to that is likely, no, you are a fiduciary, right? There are several ways that you can be considered an ERISA fiduciary. By default, there are specific types of entities that are going to be considered a fiduciary of a plan under ERISA, based on the plan design, and what happens, or through someone's actions. There are different ways that someone could be an ERISA fiduciary. The plan administrator, which that's a big P, big A, is automatically an ERISA fiduciary that is listed in ERISA as an entity that is going to have fiduciary duty, even if they delegate some duties to other people, right? And generally, the plan sponsor or the employer is going to be the default plan administrator. And again, we're talking big P, big A. So if you're thinking about, oh, my insurer administers the benefits, so that they're the plan administrator, not under ERISA. That's not always how it works, right? That fiduciary or that vendor would have to acknowledge that they are acting as the actual, named plan administrator, and they often don't. Okay. Mind you, employer plan or employer staff and officers can also potentially be fiduciaries based on the actions or the functions that they perform for the plan, right? ERISA is interesting because fiduciaries are all kind of jointly and severally liable, which means that all of them as a group, but then also individually, they could potentially be subject to ERISA and liable for any mistakes or failures that happen, right? So when we talk about the employer staff or officers who might run a company and who make decisions on behalf of the plan, then we have to ask, okay, are they going beyond those administrative functions? Do they have authority to make decisions? Do they have discretion over the plan or the plan assets? Because if that happens, then generally they would also be considered a fiduciary as well, right? And so when you have one of those staff members who potentially provides assistance specifically with group term life plans, outside of just providing the forms for the person to go to their, insurer, then any kind of assistance or advice could potentially get them into that fiduciary area, because of the fact that they're giving employees help on an issue, right? And so then what does it mean specifically to be an ERISA fiduciary of a group term life insurance plan? And the answer there is that generally there's a requirement under ERISA to act in the best interest of plan participants and beneficiaries. The whole idea of a fiduciary is really that you're doing things on behalf of other people who are trusting you to get something done for them. And that is kind of what ERISA is based on. And so generally employers, when they're offering this plan, still have to act in the best interest of those plan participants and beneficiaries. They also have to follow the plan document terms, and that's really going to be important. And we're going to talk about a couple of lawsuits in a minute, but that's really going to be important because if an employer is offering a group term life plan and is not actually in operation following the terms, then that could mean that the person's group term life coverage is at risk, and that's when you end up with a lawsuit because someone doesn't have coverage they thought they had. Likewise, that employer should only be collecting premiums on coverage that actually is enforced or goes into effect, right? So you don't want to tell someone that they have a life insurance benefit that they don't have, but then you've also been collecting premiums for that coverage and they don't actually have that benefit. And then finally, you also want to make sure that the ERISA fiduciary employer is not providing or making misleading statements, or let's say harmfully omitting things that that employee needs to know in terms of enrollment and eligibility for the benefit, okay? Once you find, let's say, a fiduciary who says something that's incorrect and that person relies on it, then generally courts and definitely the DOL are going to look at that as kind of that person detrimentally relying on what the fiduciary told them. And they're going to want that fiduciary to potentially make that person whole, okay? So then what is the risk of, administering group term life insurance benefits as an employer? Really, again, you could be subject or be brought into any lawsuits where the employee does not receive the life benefit that they thought they had based on your communications, right? And generally, if something happens and that person does not have the life insurance that they thought they had, the DOL and often the courts are going to be looking to the employer to potentially make that person whole, right? And so if you have a situation where the mistake was not on the insurer, then generally someone is going to pay that benefit, and it might be the employer, right? And then you also run into the risk of having the DOL investigate you because of issues that are brought to their attention in regards to this benefit as well. So then if we talk about, okay, there's a risk, how do employers minimize that risk? And the thing is, really, as I mentioned, I kind of gave you an idea of what ERISA's fiduciary obligations are. And so then the answer there is like, hey, comply with ERISA's fiduciary requirements, right? So I talked about briefly the idea of only accepting premiums for the coverage that's in force, right? And so specifically with group term life, you have situations where if someone did not enroll on the benefit at the first opportunity that they were supposed to have, then they won't be able to enroll again until their EOI has been approved, right? And so if you have a system set up to go ahead and enroll them, even if they didn't necessarily finish their EOI, then it could be that they don't get approved because they have to do EOI and never did it, but then you were potentially taking premiums all that time, right? Likewise, if you have situations where certain dependents age out of being covered under the plan, but you keep accepting premiums from their parent employee, that becomes a problem as well. And then also for age-reduced amounts, you don't want to continue to take a higher amount or a lower amount when they should have, or excuse me, take the same premium for less coverage now that they have. And so if you receive that premium for the person and they believe they have coverage, and you might need to give it to them, right? And so you want to make sure you're coordinating with the carrier. You also want to understand the plan terms and how and when coverage continues or ends, depending on what goes on with the employee. So Sarah already talked about the concept of life waiver of premium or sickness and injury and kind of what happens to the group term life coverage if someone is no longer an active employee. You need to know what those terms are. Likewise, if there's conversion or portability rights, you also want to know, like, hey, when these people terminate from their employment under us, what is available to them, and do we have any obligation, as it says below, to notify them of that based on kind of what our plan terms say or what our agreement with the carrier says, okay? You also want to make sure that you're confirming the benefit summaries on coverage that's in force are actually accurate, right? And so there should be some reconciliation at some point to make sure that, people are only paying for coverage if they're actually in coverage. And then you also want to make sure that you're doing things to ensure that the staff that is working with this particular benefit is knowledgeable of the rules, as well as the plan design, so that they're responding to questions in a way that is accurate and they're not providing anyone misleading information. And then lastly, you want to make sure that you're maintaining accurate beneficiary designations as well. And so, Sarah, I want to invite you back to talk about a couple of lawsuits that we've seen recently and what kind of happened and why it's important.
Yeah, thanks, Beth. So we like case law because it provides real life examples of these issues that Beth was just talking about, right? So the first case is Jimeno. This is from late last year. Here, the employer was collecting premiums on coverage that actually wasn't enforced. So the plan required that EOI on supplemental coverage, and the HR in this case helped the employee complete enrollment paperwork when he was hired, but they never mentioned the EOI requirement. It's possible they didn't know about it. And so the employee then paid premiums on the coverage for years. So he was led to believe that he had the coverage. We're talking about $350,000. His employer also provided him a benefit summary at some point, stating that he had that $350,000 in coverage. And then he died. His spouse filed a claim And the insurance company denied the supplemental. They did pay the basic, but they denied the supplemental for failure to provide that EOI. The denial was clearly based on the plan terms, so the insurer wasn't required to pay the claim. And then that brings us to the lawsuit. So the employee's spouse, who was the beneficiary, sued the employer under ERISA, right? So arguing that as a plan administrator, meaning an ERISA fiduciary, the employer failed to notify about that EOI requirement and also failed to provide correct coverage information, right? They had provided that benefit summary stating that $350,000 was in force when it wasn't. So the court agreed, and they found that it was a breach of fiduciary duty, that the employer was acting as a fiduciary when they were handling enrollment, when they were deducting premiums, importantly, when they were telling the employee that coverage was in force when it actually wasn't. So they were potentially liable for the claim. So the lesson here is, again, just that employers need to confirm that the premiums that are being collected, it's only being collected on coverage that's in force, because they can be sued independently under ERISA, even with a fully insured plan. There's just that potential for a breach of fiduciary duty under ERISA. And that's just really a fancy term for a mistake under ERISA, when you have some sort of administration error, and it can make you, an employer, liable for the full benefit. So we're talking about significant amounts. So how to guard against this? Well, figure out some way to sync up the carrier's coverage records with premium deductions, like some sort of post-enrollment reconciliation process, some way to identify outstanding and pending EOIs. We also know that this is a DOL enforcement focus, a Department of Labor enforcement focus. They publicized a recent settlement with Prudential, a huge life insurance company. That was back in April 2023, and it followed an investigation into Prudential's supplemental life claims practices. So specifically there, the DOL was taking issue with Prudential collecting premiums on coverage and then denying claims years later for an employee's failure to provide that EOI way back when initially. The settlement did note that this issue, this practice, was not limited to Prudential, that it was a problem throughout the industry. It also noted that employers who were involved in this mistake, who were collecting premiums, right, that they could be liable for the claims where they failed to let the employees know that Prudential hadn't approved the EOI and the coverage. Under that settlement, Prudential has to go back and reprocess claims back to June 2019. You'll see a link there to our Compliance Corner article from April of this year, covering this with all those details. But it underscores the focus on this issue, not just the case Jimeno, but the DOL's investigation. Really, it's just really important for employers to sync up payroll deductions and coverage confirmation with the life carriers.
Absolutely. And I will also point out that if the DOL does not actually make every settlement public. So if they make settlements public, then they are basically signaling that this is something that they are looking at. And also some of you may be on this call and say, oh man, we have Prudential. And that could happen in any number of calls we do, but keep in mind that the DOL is generally going to have the ability to then look at and review Form 5500s just to see which employers might be offering this type of coverage and potentially spot check where they would like to. So Sarah, you want to talk about another case?
Yeah, sure. So this is the Irwood case from a few years back, and this is about conversion notices. So again, conversion notices are involved when there's a right to convert from a group plan to an individual policy. Particularly important when you have an employee who, sadly has to stop work because they have a terminal illness, because they can't get coverage elsewhere, right? And so that keeping that coverage in force in some way is critically important. So here in this case, the employee was diagnosed with terminal cancer, and he met with his employer's HR to get a plan in place for keeping coverage following his termination when he could, right? But in that meeting, the employer didn't provide conversion information. So the employee just assumed that it would continue. There was some miscommunication there. And then after his death, I think it was his spouse who was the beneficiary, filed the claim, and the insurance company denied under the terms of the plan, right? Because they were following the terms of the plan, but coverage had ended when the employee was terminated. and it was never converted to an individual policy, and it had to be in order to continue beyond his employment termination. So I want to make an important point. It's a question we get a lot. There's no direct ERISA obligation for an employer to provide any conversion notice, right? There's no model notice like we have with many group health plan requirements. But the deal is that through an ERISA fiduciary duty, right, that includes following the plan terms and acting in the best interest of participants and beneficiaries. If the plan says, you employee will receive a conversion notice from your employer, that creates a duty to provide that conversion notice. So in the Irwood case here, the insurer provided the employer, which was Wellstar, a manual that stated that the employer had to provide the conversion notice within 15 days after termination. I think this is common. And the insurer also provided a conversion brochure and a model notice to send along. So, and they didn't. So the court ended up finding that Wellstar, this was an ERISA issue. They did breach their fiduciary duty, even though one of the important facts was that HR had mentioned to this employee that there was a right to convert in the SPD. So even though they did that, because they didn't clearly state the deadline to apply for a conversion, the court found still that the employer was liable, and they had to pay $750,000 in supplemental coverage, right? These claims are big. So lessons here, it's important to train and designate certain HR individuals who can accurately discuss the plan terms, who can field those questions without leaving out key information like deadlines, really key information. And then be aware of any conversion notice responsibilities. And you can look at your plan, you can look at your carrier documents to figure out if you have those and what they are. So we're seeing more and more of these cases. They're being brought more frequently. We are reporting on them in Compliance Corner when they're particularly notable, but it's really just the tip of the iceberg. I think it's important to remember that, yes, employers may be on the hook for a claim if a beneficiary sues, right? If they end up with a problem on the coverage, but think of many more who don't ever contact an attorney. My point is that it's not just about the legal and financial risk. It's also, we're dealing with significant lost benefits after an employee dies on coverage that they thought was enforced to protect their families, their beneficiaries. And it's often based on really a preventable administrative error. So, that's why we're talking about this today. Beth, can you just take us through to kind of summarize how to prevent these errors?
Sure. So just briefly, I think we've talked a lot about reviewing the plan terms and actually even knowing what the design for your group term life is. Obviously, understanding when coverage begins and when it ends, and how it could potentially continue or be portable or needs to be converted. You want to follow those plan terms, and then obviously you want to examine your practices to make sure that people are really not falling through the cracks with how this ends up happening, right? And so, are we making sure that the premiums are only connected once the coverage is actually in place? Are we checking that with the carrier and making sure that's happening that way? If the carrier does require the employer to actually notify employees of their right to conversion, is the employer doing that, right? And then also, is there a process in place for responding to employee questions? Because obviously providing an SPD is good as long as the SPD is accurate. And you also want to make sure that you're being sensitive to circumstances and referring to all of the relevant plan terms, right? Obviously, if we're talking about a death benefit, then somebody has died. And so that is already kind of a time that is really hard on people, but it becomes even harder when the employer is not, sure of what's going on. And then obviously you might be saying, okay, we probably have some problems or things that we have to look at, and you want to potentially go back and review your practices in this regard and get with counsel if you know that there's been breaches of fiduciary duties. So that's ERISA. And now, Sarah, do you want to take us through the IRC Section 79 rules?
Yeah, so from the not so fun stuff to the really not so fun stuff, right?
Agreed.
To tax rules. Okay, but we'll get through it together. So the general rule, right, is that all employer provided benefits are taxable unless the code provides a specific exclusion. And it turns out that the code, right, the federal tax code, the Internal Revenue Code, does provide an exclusion on group term life coverage, and that's $50,000 which we talked about before, can be significant, $50,000 if it's non-discriminatory plan design. And that is a specific meaning, which we're going to get into in a couple slides. So just put a pin in that. But a central concept under Section 79 is determining the value of the coverage. So when I say value, I mean that distinct from the cost of the coverage being what employers or employees pay. So we use a table provided by the IRS that determines that value. And we're going to look at that in the next slide. But there's this threshold question on whether Section 79 even applies to the coverage. And the code can be a bit tricky on this, but we know that is going to apply most of the time to coverage that's set up through the employment relationship. The code actually uses the phrase, which is in purple there, employer provided. Note that that is not only employer paid. There are in fact two ways to meet this definition. They're numbered right there. The second is dependent on whether the rates straddle the table values. So just one final note on applicability before we get to the table values and straddling. Section 79 only applies to coverage on the employee's life. We're going to touch on dependent coverage tax rules at the end, but let's move on to straddling. So there's the IRS premium table. On the left, you'll see it sets increasing rates for each $1,000 in coverage per month based on the employee's age bracket, the age bracket that they fall into, depending on their age at the end of the year, at the end of the taxable year. So the straddling concept, again, this is for applicability, and it's really about whether some employees' rates are subsidizing other employees' rates. So if you think about straddling as a foot on either side of a fence, with feet being the rates that employees are charged and the fence being the table values, if at least one employee's rates are lower than the table and at least one employee's rates are higher, then you've got feet on either side of the fence, meaning the rates are straddling. But if all of the premium rates are at the table rates, then think about that as all feet on the fence, so there's no straddling. And if all of the premium rates are below the table rates, then all of the feet are on one side of the fence, so no straddling. And it's the same if they're all above the table rates. And then finally, if you have a situation where all of the premium rates are at or below the table or at or above, so that's like having 1 foot on one side of the fence and another on the fence, right? In that case, there's still no straddling. Beth, anything to add there? So make sure I explained it clearly enough.
No, I think it's a really hard concept, but I do think that the straddling one side of the foot fence thing, I think that's helpful. But I also think that ultimately it kind of is important to start talking about imputed income, which you're going to talk about next.
Yes. Well, next, we're just going to go on to quickly why it even matters if Section 79 applies. So now that we know what the table is and we understand what straddling means, why does it matter? So up there in the first section, if Section 79 applies, there are these two consequences. The first is the $50,000 tax exclusion. So that's a good consequence. It's subject to the non-discrimination rules, but you get that $50,000 tax exclusion. And then two, it's subject to the imputed income rules, which means that employees may have to pay additional taxes even after the paying premiums post-tax. And then, let's say, you want to avoid Section 79 because you want to avoid imputed income on low supplemental rates below the table value. We've got to have coverage that does three things. First, all of the premiums must be paid by the employees post-tax. Second, the coverage must be independently underwritten, so it cannot be packaged together with the basic, right? The rates cannot be dependent on each other. And then the premium rates cannot straddle the table rates. So let's move on to non-discrimination, the next slide. So I've been mentioning that a bit. Okay, so, right, remember that the $50,000 coverage exclusion, it's only going to apply to all employees if non-discrimination rules are met. So at a high level, this means that coverage can't discriminate in favor of key employees, and key employee has a specific meaning there. And if the coverage is discriminatory, then the keys don't get that $50,000 exclusion. Importantly, non-keys still do. Non-keys are not impacted by a discriminatory design. So who are your keys? Well, they're listed there. It's officers with compensation over a certain threshold, certain owners. And so once you determine who your keys are, the next question is whether they're favored in eligibility or in benefits. So eligibility to participate in the plan. Note that certain employees can be, or they are excluded from testing, part-time, seasonal employees, certain union employees, and employees with less than 3 years of service. And then the other question is whether these key employees are favored in benefits or contributions under the plan. We do have a safe harbor. We do have 2 safe harbors, actually. It's providing a flat dollar amount or a percentage of compensation. So like providing 2 times or 3 times everyone's salary, even if it favors keys because they have higher salaries, that's a safe harbor and it would not be a discriminatory plan design. All right, so we can't get into testing specifics on like different flavors beyond the safe harbors we just mentioned, because that can, if it becomes complicated, it's really a question for a tax advisor, a legal counsel who's aware of these rules, but we can certainly flag some problematic plan designs like we have here. The first would be providing a higher fixed amount to certain keys, like a CEO. That's clearly discriminatory. Only providing keys the opportunity to purchase supplemental, or allowing keys to elect a higher multiplier of salary. So the solution would just be to offer the same to all full-time employees, like the percentage or multiplier of a salary is okay, but it's not the end of the world if you have a plan that's discriminatory, right? It's not completely prohibited if you have a coverage design that discriminates in favor of keys. You just need to make sure that those keys are not getting the $50,000 tax exclusion, right? Remember that those non-key employees, they're not going to be impacted by a discriminatory design. So it's really important to first identify your keys, and then 2, figure out whether they can still get that exclusion based on the design. So
Sorry,
next,
I'm on mute. I'm sorry. One
No
thing
problem.
I will bring up is some of you might be thinking, oh man, we do have a discriminatory benefit, and that might be the case. And you might also say, well, you know, some of our higher ups and our key employees need to have more coverage. So what do we do? And we will point out that there are additional types of benefits that might be non-qualified benefits or executive benefits that are available for you to take care of some of those key employees. Just the group term life insurance program is not the program that you would use that for, right? Unless they are willing to lose they're basically $50,000 in exclusion. And so keep in mind, you can talk to your NFP advisor about other ways to potentially help your higher up employees get some kind of other coverage to deal with the fact that they are such high earners.
Great point. Thanks, Beth. Okay, so imputing income. So this is the last concept under Section 79, and imputing income. At a high level, it just means that you have to add the excess value of the coverage to the employee's compensation in order to tax, in order to withhold taxes. So the rule again is that the value of coverage over $50,000 must be imputed back to the employee. Excuse me, and the value is determined by those table rates that we looked at a couple slides back. So there aren't going to be any tax consequences if the coverage is $50,000 or less, and the plan is non-discriminatory, or if it's $50,000 or less and you're talking about a non-key. And then for employee paid coverage, right? If the premiums are paid at or above the table rates, there's not going to be any additional imputed income there. So here's a step-by-step calculation to determine any excess value that needs to be imputed. First, it's figure out what the value actually is. And then 2, you're going to subtract that $50,000 exclusion if it applies to that employee. And then go back and look at the table values, do some math there because it's per 1,000 per month based on age, and then subtract any premiums that the employee is paying post-tax. Okay, so let's look at a couple examples here on how to crunch the numbers. So we have George, who's 40 years old. So he's in that 40 to 44 age bracket. And George gets $250,000 in coverage. That's all employer provided. We've determined it's employer provided for the full calendar year. So $100,000 in that is paid by George's employer, and then he's paying $150,000 on a post-tax basis, and that's costing George $100 for the year. And the coverage satisfies the non-discrimination requirements. So here's what we got for the calculation. We start out with the $250,000. We subtract $50,000 because that's the exclusion. So we're left with $200,000, and then we go to the table rates, and we see that in George's age bracket, it's 10 cents per month per thousand. So we take 10 cents, we multiply it by 200 because there are 200,000s, right, in George's coverage. So that's $20 per month, and then we multiply it by 12 months. And so George's taxable value for the year is $240. But George has paid $100 of that post-tax, so we discount for what he's paid post-tax. So George needs to have a $140 additional income imputed. And then the next example we have Tina. So this example is quite different. Tina is in a much higher age bracket. She receives a much higher amount, $1 million. In coverage for the full calendar year. $200,000 of that is paid by her employer, and then she's paying premiums on the rest, $800,000 post-tax, and that's totaling $5,000 for the year. So here we're going to assume that the coverage does not satisfy the non-discrimination requirements, and Tina is a key employee. So we start out with the value of the employer provided coverage. It's $1 million. And then Tina in step 2 does not get that $50,000 exclusion because the coverage is discriminatory and she's the key, so she doesn't get that advantage. So we're left with $1 million that we need to calculate for any imputed income. You crunch those numbers, you'll see there that the table rate in her age bracket is significantly higher than George's. It's more than 6 times higher. So that's why and she has a much higher amount of coverage. She has she has $1 million versus I think George's was 200,000. So we end up with $7,920 in taxable value for the year. Now that full amount isn't imputed to Tina because she's paid $5,000 post-tax in premiums. So we discount the $7,920 by the amount she's paid in post-tax premiums, and that leaves us with $2,920 to impute to Tina. All right. So now the last topic we're going to talk about is dependent coverage. So Section 79, all of these rules that we've been talking about it doesn't apply to dependent coverage. We get these rules from other parts of the code. So here are the main rules. First, dependent coverage cannot be paid pre-tax. It can only be employer paid or be paid post-tax by the employee. Second, there's this de minimis exclusion. So employer paid dependent coverage is not taxable if it's under $2,000. There's no tax consequences. But if it's over $2,000, the entire amount is taxable, not just the amount over $2,000. That's called the de minimis exclusion. And now third, to figure out the taxable value of the dependent coverage is going to be similar to what we just talked about for Section 79. It uses the same table rates, but based on the insured's age. So the spouse or the domestic partner or the child is based on their age at the end of the taxable year, not the employee's age. So you impute the income based on those values. So to break that down, right, if the employer paid for the coverage, you're going to impute income directly based on the table rates. But if the employee paid for the dependent coverage at rates that were at or above the table rates, there's no additional income imputed. But then the last scenario, if the employee paid for dependent coverage at rates below the table rates, then you have to impute income because they paid less than the value. but you discount for what they paid. So there's a simple formula there that kind of matches the one in Section 79.
Now, Sarah, I do think
Yes.
it's a good idea just to maybe say in layman's term what imputing is, right? Because I think we've got that question a couple times. And I'll take a stab at it and you can correct me, but the idea of imputing income is basically treating you like you received additional payment or wages and then taxing that amount, right?
Yeah.
And so like, I think that's kind of maybe the layman's way of saying what imputed income does.
Yeah, it's a tough concept. Yeah.
Yeah, but it's not that you're taking that much money away from them. It's really more that you're saying, well, we provided you this additional money, basically, and you have to be taxed on that.
Yes. Yeah. It's sort of like ghost income, right? In order to just like take the taxes from it. So you have the additional taxes, but you don't have the actual income in your paycheck.
Correct. And I will make it clear that you are also imputing income with domestic partner coverage, right?
Yep.
And if your employees receive, let's say, wellness benefits or gift cards, it's the same type of concept. Whereas you were saying, hey, you received something else of value that we need to, reflect so that it is taxed appropriately.
Yes.
So yes, great discussion of IRC Section 79 and the rules we get from there. And so I think we have time to go on to the conclusion. And if you have some more questions, go ahead and put them in the Q&A. The team can deal with the questions that we may get in. So some takeaways here. As we mentioned, we're talking about this right now because we're noticing that there's some widespread non-compliance, and it's not just us noticing it. It is obviously, the courts are also getting more cases on it, and the DOL is taking notice of it. And so it's clear that some of the administrative, requirements are kind of falling through the cracks. And then obviously taxation is another concept that employers have to consider. Obviously, with the lawsuits and any kind of DOL enforcement, the employer has to be concerned about that being liable for the full benefit, right? And so I know that a lot of us think about group term life as a very inexpensive benefit. And it is until you have to self-insure one of those actual death claims, right? Because that's where it gets expensive, right? And so, that's what you want to potentially avoid. You also want to avoid, let's say, a DOL audit, and obviously lost benefits to the employees as well, right? And no one wants to explain to an employee's beneficiaries that the life insurance policy they thought they had is not actually there because it was not administered correctly, right? And so employers really need to review their current and past practices. They, definitely want to correct them now, right? Once you are, that that there's a problem, you definitely want to fix that. And then also any kind of past mistakes and how those are remedied, if they should be, is something that you would want to talk to legal counsel about, right? Because counsel is best suited to help you know kind of what you should do to fix past failures, okay? Now, mind you, we're still talking about kind of DOL enforcement as well as lawsuits. We're not aware that there's any, current IRS enforcement, right? But this could be something that comes up now because of the multiple cases that we're seeing and the DOL issues. And so likewise, you want to deal with, correcting this going forward and dealing with any retroactive mistakes with your tax advisor or tax counsel. One thing I will mention, because I think we got a few questions about the role of payroll companies in helping you do this. And so I will mention that, theoretically, your payroll provider is able to do the actual, imputed income function, right? But I would wager that you as an HR department at your company would have to give them certain direction as to how you are going to do this, right? And they would also need to know like certain aspects of, what you offer, what is employer paid versus what is employee paid. And they would also need to know, if the cost of the coverage was actually set at or, below the table. And so that's not something they would automatically know, right? So there should be, we would expect some conversation between you and your payroll provider because it would not be automatic, right? Even though they can actually achieve the mechanism of imputing the income. Sarah, would you say that's right?
Yep, absolutely. Yeah.
And then I also saw, I think, a question of where the rates are. And the rates are, we call them the table 1 rates, but it's actually what, table 2.2, Sarah?
Yeah, they call them table 2.2, and they're in IRS publication 15.B.
Yeah.
You'll see on the screen here, we have a new publication, new NFP publication that goes through everything that we talked about today and a little bit more. And it also has the table in Appendix A.
Absolutely. Absolutely. And so, yeah, I mean, the good thing about kind of having resources like this that we can provide to you is that we just give you a bunch of information and you have that available. You could potentially take this resource to your payroll provider and say, hey, we got this, and we're now, on notice of having to do this. How was this set up? If you were not a part of when it was set up, and make sure that it was set up correctly. I will also say, that the table rates changed over the years, right? So if your company, let's say, set it and forget it 30 years ago, it's probably not correct anymore, right? And so you want to make sure that you are routinely also looking at this, but we're going to continue to offer kind of the resources and articles and things on this topic as they come up. All right, Chase or Sarah, anybody, are there some questions that we want to address? All right.
Actually, I'll jump in with one question. Can you hear me?
Sure.
Yeah, so just a couple of questions about the timing, whether imputed income applies based on the date of coverage for the employee or the invoicing practice of the carrier, which I thought was interesting because those could be mismatched a little bit, or the carrier may send like at end of the month. So my thought was that imputed income is always going to relate to the coverage date, because it relates to, whether the employee is getting the value of the benefit, right? And so any thoughts on that at all? And then one other is whether the IRS rate table changes from year to year. Is that something they have to monitor every single year? Or does it basically stay the same?
Yeah, so on the first question, I agree with you, Chase. And also it's based the examples there when we did it like throughout the year, it's really month by month that you could also break it down. You don't have to do it just at the end of the year based on coverage by each month. I just did an easy calculation times 12. And then the table rates, no, strangely, they do not change every year. I can't tell you when they last changed, but they're not like an indexed amounts that change every year.
Yeah, similar to the $50,000 level not changing since enactment, right? Kind of pretty static.
Yeah, that is strange, but no, that hasn't changed.
Okay, I think that's all I've got, except actually one other question: is the child life insurance included in the imputed income calculation?
But yes,
how do you look at those?
Child life insurance would be under those dependent coverage rules. So it would be imputed based on that table, based on the child's age, but the table ends, or it starts at like age 24 and under. So that can be a simple calculation for all covered children.
We will also say that in researching this and having this conversation about this, we did come across the fact that there's a lot of people who will opt to potentially do imputed income on spousal dependent based on the life of the employee, which is technically not how that's supposed to happen. We had a couple questions in the question and answer about that. And so that was even news to us. So heads up that, that might be something to talk with your payroll provider about as well.
Yes, it is based on the age of the insured at the end of the year. Yep. If I could just return to one party note about the ERISA. So I know the rules can be complicated and it can be overwhelming, but just sit down with your plan, right? And look at the plan terms. The plans that I've seen are written pretty clearly, right? They're fairly simple, but it's worth taking a moment and just looking at what it says and making sure that everything's in line with what you expect it to be.
I think with that, Amber, I think we're ready for you to give your outgoing spiel. Thank you everyone for attending.
All right. Well, thank you, Beth and Sarah, for sharing your valuable time and expertise with us today. To reiterate, today's presentation was recorded. We will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you everyone for joining us and have a great day.